Hi, my name is Elliot Gu, and I'm co-founder and chief market strategist for the Pig vs. Bear trading service. Today I want to explain one simple yet powerful indicator I use to trade swings in crude oil using exchange-traded funds or ETFs. Over the 3 years since we launched Pig vs. Bear, we've recommended trades in crude oil on several occasions using these same ETFs, and they've been among the most successful and most profitable trades we've recommended in the service. We've traded oil from both the long side, betting on oil prices to rise, and on the short side, betting on oil prices to fall. And we've generated gains as high as 153% trading oil using simple ETFs you can buy through your normal online brokerage account. You do not need to trade oil futures to make these trades work. I didn't make this video to boast or brag about our success trading oil-levered ETFs in Pig vs. Bear. I created this video today because I keep hearing pundits on financial television and in the mainstream media claim that you can't predict the price of oil. Or worse, some will sit there telling people that oil prices just follow trends in the US dollar or are driven solely by geopolitics or the politics of OPEC and the Middle East. However, I must warn you, that's all completely wrong. And if you follow that sort of logic and that sort of narrative, I think it could cost you some serious cash. In fact, we've actually made the most money on oil trades recommended in Pig vs. Bear when we've bet against this conventional wisdom and the popular narratives about the dollar, OPEC, and geopolitics. For example, we made money on the short side in the first half of 2017 because we saw clear indications that the market consensus view that crude oil prices would rise because of OPEC's deal to cut production was dead wrong. I'm going to show you one indicator I watch that helped lead me to make that call and others regarding oil prices over the past few years. Just to be clear, I'm talking about buy and sell signals for the commodity itself, mainly West Texas Intermediate or WTI oil prices. And I'm making these calls over holding periods ranging from a week to a few months. Warning, if you're looking to day trade oil or trade moves lasting just a day or two, then the indicator I'm going to discuss in this presentation today probably isn't going to be that interesting or useful to you. And that's just not the style of trading we do in Pig vs. Bear. So let's get started with this simple rule. Don't watch oil prices. Watch the shape of oil prices. Let me show you exactly what I mean by the shape of oil prices. This first chart shows the futures curve for Brent crude oil on June 15th, 2016. I picked this date, which is nearly 2 years ago, because oil prices had rallied sharply from a low under $30 a barrel in January 2016 to around $50 a barrel by the middle of June 2016. So the narrative in the media at that time was that oil prices were back in a bull market, and some were beginning to talk about the end of that long bear market that started back in the middle of 2014. However, what this futures curve on your screen tells me is that the rally in oil prices back in June 2016 was not based on a firm foundation, and that eventually, sooner or later, oil prices were likely to weaken based on poor fundamentals. So here's why. This curve simply shows me the price of crude oil for delivery in future months. So at that time in mid-June 2016, you could buy a futures contract here for delivery of oil in August 2016 at a price of $49.68 per barrel. Or you could buy a contract for delivery of oil in February 2017 at a price of $51.82. Or December of 2017, about a year and a half later, at $54.21. So as you can see, this futures curve has a positive slope, which just means it moves from the lower left-hand side of your screen to the upper right-hand side. Because the price of oil for immediate delivery is significantly lower than the price of oil for delivery further in the future. So this is a condition we call Contango, and simply put, it's bearish for crude oil. So here's why. Contango is actually the oil market's way of telling us that the physical market for crude is oversupplied or in a glut situation. When the price of oil today is lower than 6 months from now, market participants have every incentive to store barrels of crude oil. So let's use the June 15th, 2016 futures curve as an example of how this could work. A market participant at that time could have bought oil for August delivery, that's August 2016 delivery, at a price of around $49.50 a barrel. Then the trader immediately sells that same barrel of oil for delivery in February 2017, so that was about 6 months in the future, at a price of $51.82 a barrel, locking in a profit of about $2.32 per barrel. Now, provided the cost of storing that oil is less than that $2.32 a barrel over 6 months, that's a riskless profit for the trader. It's riskless because the purchase and sale prices are locked in using the futures market, so it doesn't matter what the price of oil does over that 6-month period. Or let's just think about it from the point of view of an oil producer. Would you rather drill for oil today and sell that crude at a price of $49.50? Or manipulate your drilling and production plan, your capital spending plan, so that you could produce those same barrels a year later in June 2017 when the futures market offers a much higher price of nearly $53 a barrel? You're probably going to decide to leave those barrels in the ground as long as possible to take advantage of those higher future oil prices. So do you see how a futures market in Contango provides an incentive to store oil or produce less oil today? It's just the market's way of telling us that the physical market is oversupplied and incentivizing market participants to supply less oil. Okay, so that brings me to this. How did that signal nearly 2 years ago work from a trading perspective? Because that's what we all really care about. Well, despite a series of bullish oil headlines in the summer and fall of 2016, and these were mainly headlines about a potential deal between Russia and OPEC to cut production, the price of oil really struggled to rise above its June 15th close, and it made a couple of trips from the low 50s to the low 40s, which is a pretty nice move. These are very tradable moves in oil on the short side. Now, Contango in the futures market was telling us that despite all the headlines and all the noise out there, the crude oil market remained oversupplied. So let me show you this Contango in another way. This chart shows the slope of West Texas Intermediate crude oil futures over the coming 12 months. So the calculation here is pretty simple. I look at the price of WTI for delivery in 12 months, a year from now, and subtract the price of WTI for delivery in the front month, which just means the WTI futures contract that's closest to right now for delivery. That's the next one for delivery. So when this number is positive, the futures market is in Contango because the price of oil for delivery a year from now is higher than the price of oil right now. So I plotted this indicator of the oil market shape going all the way back to the end of 2013. So do you see how WTI futures entered Contango here in November 2014? Well, at this time, crude was trading around $80 a barrel and was just coming off highs well over $100 a barrel in the summer of 2014. So in short, the oil market was in the early stages of a bear market that would eventually see oil tumble all the way down into the mid-20s per barrel, and that was in early 2016. And here's what's really interesting. The price of oil did see significant market rallies in 2015 and 2016, and these were bear market rallies, rallies within a larger bear market. But this simple chart showing the shape of the futures curve told us that these were opportunities, these bear market rallies were opportunities to short oil and trade a sell-off in oil using an ETF that I'll show you in just a moment. For example, while the price of oil rallied from $42 per barrel in mid-March of 2015 to highs around $62.50 in May and June of that same year, do you see how the WTI futures market remained in Contango? Now, it's sure, the steepness of the Contango curve declined here in the spring of 2015, but the futures market never even came close to shaking this Contango entirely. Well, that was bearish for oil prices, and it told us that while the price of oil had bounced, the physical market for oil remained in a severe glut. Nothing had really healed for crude oil in the summer of 2015. To trade this move in pig versus bear, we used an exchange-traded fund called the ProShares Ultra Short Crude Oil Exchange Traded Fund, which trades under the symbol SCO. This ETF is designed to go up in value by 2% for every 1% move lower in the price of West Texas Intermediate crude oil. So buying this ETF represents a bet on falling oil prices. So here's a chart of SCO in the second half of 2015 and in early 2016. In pig versus bear, we bought this ETF on a few different occasions, a few different entry points between April and November of 2015. which allowed us to book gains of as much as 153%, as I said, in January 2016 as oil plummeted and SCO shot up in January and February again of 2016. Again, I didn't create this presentation to brag about an oil trade we recommended 2 years ago, but to explain how the simple oil market shape indicator has worked in the past and to explain what it means today and how we've been looking to trade oil here in 2018. Here's a chart of the WTI oil futures curve since last summer. I told you that when this indicator is positive, it indicates that the futures market is in contango. Well, the opposite of contango is what's called backwardation, which just means that the price of oil for delivery in the future is lower than the price of oil today. When the market is in backwardation, this simple indicator I've plotted here will be a negative number. Simply put, backwardation is bullish. When the price of oil today is higher than a year from now, no one wants to store oil. After all, why would you store oil just to earn a lower price in the future? In backwardation, the futures market is trying to communicate a simple message to us. Supply more oil now as there's a physical shortage of crude oil on the market. So do you see how the WTI curve flipped from contango to backwardation in September, October of last year, of 2017? Well, that tells me that for the first time since 2014, rallies in oil prices are actually supported by market fundamentals. The rally in oil from lows around 42 bucks a barrel last summer to the mid to upper 60s a barrel today is for real. So our bias in pig versus bear since last summer has been to trade oil from the long side, buying dips and breakouts with the idea that prices should generally rise and or remain supported on any dips as long as this market remains in backwardation. To do this, we use another ETF, which is called the ProShares Ultra Crude Oil ETF. And that one trades under the symbol UCO. It is designed to go up in value by about 2% for every 1% rally in the price of WTI oil prices. In short, the shape of the oil futures market is the way the market itself tells us volumes about the health of supply and demand conditions. It told us back in 2015 that the physical oil market was very sick, even when prices saw significant bear market rallies. And it tells us that today, right now, this market is healing, regardless of the latest headlines, trade war concerns, or economic data. And for those of you who want to follow along at home, you can find price quotes for WTI crude oil futures on the Chicago Mercantile Exchange, the CME website, which is at www.cmegroup.com. Click on the Trading tab and then select WTI crude oil. Follow the difference between near-term oil prices and futures prices for delivery in 6 to 12 months to get an idea of whether this market is in contango or backwardation. And I believe this simple indicator can help you get a better idea where oil prices are likely headed over the next few weeks and months. It's certainly a market we're looking to trade in pig versus bear using the ETFs I mentioned, trading under the symbols SCO if you're bearish on oil and UCO if you're bullish on oil. And we're looking to do a lot of these trades here over the next few months. Watch your inbox because over the next few days I'll send you additional videos, presentations, and reports explaining some of the key indicators, techniques, and strategies we use in our exclusive pig versus bear service for trading markets like oil, the broader stock market, gold, and bonds. Thank you very much.